Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the much anticipated Fed rate cuts and the new timeline he thinks we can count on there. Logan, welcome back to the podcast. And I'm excited about this topic. Will the Fed cut rates next week? That's what we need to know.
You know, it's Friday morning, and we just got the personal consumption expenditure inflation report. That's what the Fed wants to track, right? That's their 2% target. It's not so much about CPI inflation, but we sit here and there is a lot more discussion about Fed rate cuts, especially from people that weren't in the Fed rate cut category. So the question now is, will they actually cut rates next week to try to get ahead of any kind of really negative labor data lines to where they have to cut more? What do you think, Sarah?
You know what? I'm team cut rates. Let's do it. I think they're feeling the pressure.
Okay, so my personal view, the last 6 rate hikes didn't need to happen. I would have been 100% fine with what the Fed wanted to do originally, is to keep kind of the Fed funds rate kind of toward the 3, 6, 12-month core PCE. And they went ahead and became very restrictive, and they've stayed here the entire way. So we're sitting here, headline PCEs 2.5%. We've made so much progress on the inflation data on a year-over-year basis, but still no rate cuts. Now, I'm in the Fed's not going to cut rates next week camp, because they usually would make a really, really big signal to the marketplace early on if this was a topic. However, September is in play. We're going to have jobs week next week. And I think one thing that we always have to remember with the Fed, they asked the Fed, they said, if we have really positive jobs number, are you going to hike rates or keep rates up? And they said, well, no, because inflation growth rate fell more than we thought in 2023 with much better jobs data than anybody thought. So it's not the labor market that's going to push them to hike rates or keep, it's the labor market breaking. That was kind of always the goal. So they're not going to cut next week, but the verbiage, right? The verbiage is going to be the key. They can make life a lot easier for themselves and everyone else if they start saying the right words and moving into the rate cut cycle. Because we have to remember, even if the Fed had cut rates 3 times already this year, they are still restrictive based on their own policy, not what I believe or anybody else in the market believes. I think there is a camp of people that have been calling for recessions for 2 years and they haven't gotten it. So they really want the Fed to stay as restrictive as possible. It's only one group of people, Sarah. And then there's a camp where a lot of the kind of maybe the Fed should not cut rates camp people are now coming into, okay, we need to like turn it around, get to the next stage, because some of the labor data is now getting softer for them. And then there's well, what about inflation? Well, growth rate of inflation fell a lot already. It's not a surprise, but the labor data is key. So for everyone here, like we've always said, for how many 2 years now, Sarah? Paper, rock, scissors. The labor data is more important than inflation. The labor data is more important than the Fed rate cuts, right? Because if the labor data starts to break, that's what's really going to drive the 10-year yield lower. And why is that important, Sarah? It's the slow dance. What drives the 10-year yield lower, the Fed will follow, and this is how economic cycles have worked. The question is, do they try to get ahead of the curve this time, or are they behind it? Some would already say they're already behind. There's no way they can really turn fast enough. They're not going to be cutting aggressively. So the verbiage is key. When this podcast comes out on Monday, we'll all be here. But as we speak right now, the 10-year yield is still at 420. Even with all the progress we've made. even with job openings falling and everything. This was always the Fed's intention, to keep policy as restrictive as possible, to get the labor data to be as soft as possible. So now where everybody is talking, whoa, some of this stuff starts to look recessionary. So I think they're doing what they intended to do. Getting people to believe that has been difficult the last 2 years, but we have all the evidence in the world right now with where the Fed funds rate is, where the bond market is, with the 12-month PCE data at 2.5% headline. This was always going to be about attacking wages, labor supply, and they're getting to some of the levels that they really wanted to hit.
So we have that background, right? We have the data background they can look at and say, this is what we're making the decision on. I think for you, one of the things that you've seen change is just the language from Fed presidents or former Fed presidents who usually are super dovish and like, against cutting. And all of a sudden they've done a flip-flop.
Yeah, I think, with Dudley's situation where 7 weeks ago, the Fed funds rate is not high enough to destroy growth. Now, the GDP report came out, was better than anticipated. We'll probably get some revisions on that, but you have to look at this. I think some people now are starting to, they don't want to be on the wrong side. You don't want to do what everyone has seen, the Fed just be behind the curve and then all of a sudden cutting because things are breaking, right? And I try to get people to focus on residential workers, job workers. What's the one thing that we've seen always is residential workers lose their jobs going into the recession. Now, that hasn't happened yet, but we have multiple data lines that are taking us to that area. And again, this is a policy choice. It's not like they're not seeing the same data all of us are. This is a public policy choice. This is why I always said the Fed had a COVID-19 housing economic policy just to depress sales and keep housing in a recession as long as possible. But when the construction workers lose their job, there's your front line of jobless claims rising. Jobless claims starts to rise. Construction workers lose their jobs. There is every recession we've had, in recent history. So I remember in March, it was March 2023, I was went on CNBC and said, I think they're frustrated. The labor market in the construction isn't breaking. They're not getting wages to come down fast enough. So now we're in a different spot. Now, the ball is in their court. There's no more breakaway inflation. There's no more wage growth out of control. There's no more 1970s, all this stuff. You didn't need to have a job loss recession to break the growth rate of inflation down. All of those people, shame on you. All of you on X and those YouTubes who said you had to create a job loss recession to bring down inflation. Shame on you. We're going to do the shame thing like Game of Thrones. We're going to get them and we're going to have them walk down a town and just go shame, 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 shame. That's what we're going to do. So hopefully, they land the plane, they get to the next stage, and we take it forward from there. But I don't think or this week when this podcast comes out, will be the Fed rate cut. But the language is the key. The 2-year yield is already have two rate cuts already priced in. And we take it from there. And remember, next week is jobs week. Labor data is key. Labor data is key to everything. That's why the 10-year yield is still at 4.20. That's why the Fed funds rate's at 5.5%. The labor market hasn't broken for them to get aggressive, and then the 10-year yield goes down well before the Fed starts to get really aggressive with rate cuts.
What if we get a jobs report that shows really strong job growth? Is that just going to
the knees? That's the thing. The Fed has said a strong jobs report isn't going to change their mind. The internals matter. So when I talk about internals, I always tell people, let's focus on job openings data. That's what they cared about. Well, job openings went from 12 million down to 8 million. I was thinking they're going to wait till 7 million before they start to kind of talk more dovish, but 8 million seems to work for them because the quits ratio is what they really focus on. Sarah, they hate it. When Americans are making more money and they have choices, it just drives them insane. People actually quitting their jobs for higher paid jobs. The Fed goes, no, get back in line. No, no, we do not accept a higher wage and people having choices. So now we're not there anymore. So you can have an upprint or a negative print. They're kind of just looking at the internals. And again, they've said this time and time again for the last 6 months. We follow the labor data. The labor data is so resilient that it's allowed us to be hawkish. They literally say these things out in public. It's like nobody remembers this. I was like, what? Chairman Powell said a few months ago, we watched jobless claims. Well, jobless claims have been falling for months. Yeah, it has been. And now it isn't. So this is why I always highlight jobless claims data. Once we get toward that 323,000, the labor market is broken then. So it's a choice now. We're about 100,000 away from that level. They can try to get ahead of the curve and maybe limit the damage, or are they just going to wait until we get to the breaking point and then go, oh my God, we didn't see this coming, so.
So, this is later than any of us thought it would happen, right? I mean, towards the end of 2023, we were like, okay, this could happen. And early 2024, it kept getting pushed. Well, maybe it's March, maybe it's May. Is this, from your perspective, why is this so different this time?
The difference now between the last, I would say, 16 months is that the labor data the Fed tracks has gotten noticeably softer for them. And they've let people know that too. Okay. I think that's the difference. Early in the year, the labor data wasn't breaking enough for them, but the internals were. And this is why, we've had plenty of times where the marketplace puts in rate cuts. Remember, after the Silicon Valley banking crisis, they were doing 6 rate cuts already, and then the Fed's hiked rates right after that event. Isn't that crazy to think that, the marketplace was doing, the 2-year yield fell so much and they were pricing in rate cuts, and then the Fed went ahead and the Fed has levers to pull to limit damages if they want to. So that's a whole different topic we can discuss later. But here, the 2-year yield is going lower because the labor data is getting softer. So again, a very simple model for me, job openings at 7 million, the quits percentage pre-COVID. So the Fed feels a lot better about the job openings data. Wage growth is still too high for them. They want 3% wage growth because they only believe 1% productivity. Wage growth is at 3.9%. That is not, Sarah, that is not acceptable. 3.9% wage growth? No. Shame on you people. What do you think? So there's still things that they want to go lower down, but they can, be less restrictive right now. And again, policy choice. It's all in their hands at this point from where we are, because again, the confusion for everyone in the real estate or mortgage industry is that they thought that the growth rate of inflation falling as much as it has meant mortgage rates would go lower. That's not how it works in this cycle. And we'll have to take the labor data next week, what the Fed says, and we're still here stuck at that 4. How many weeks have we been talking about this 420 level? This is going to be a tough nut to crack, and it's just we're just sitting here. So we'll take it one day at a time. But again, paper, rock, scissors. Labor data is more key than anything else, than Fed rate cuts, verbiage, or anything like that. So we have a big week. We have a huge week with jobs reports and the Fed meeting.
Well, let's talk about, okay, we think we're going to get a rate cut. Are you just going to get one? How big will it be? And then what does the market do alongside that? So basically the question I'm asking is, how low could rates go this fall?
The rate cut doesn't matter as much as the labor data. See, right now, the 10-year yield has already fallen from the peak, right? We had 5% in 10-year last year. So we're at 420. So the bond market is somewhat ahead, but the bond market is not into job loss recession mode yet. When the labor data starts to get, like, for example, the Fed could cut rates and you don't see much movement on mortgage rates. But if the labor data starts to break, I'm telling you, when jobless claims starts to break, the 10-year yield is not going to care what the Fed wants. They're just going to go, hey, listen, you're not going to meet for another 4 weeks. We're going to. So if you want to target, the 10-year yield can possibly get down to 380. And if the spreads get better, that could get you to the mid to low 6s if the spreads get better in that point. But it does need the labor market to get softer, because the Fed can no longer be as restrictive as they are if the labor data is, and this is why I've always said, if you listen to them, they said, we are here only because of the labor market. So I know a lot of people are talking about the rate cuts, and that's good, and that'll be good for spreads and everything. But we all know rate cuts are coming now to a degree, but the 10-year yield is still at 4.20 because the policy is still restrictive. We're talking about for housing, right? And we're in the third calendar year of the lowest home sales ever. 5-unit permits are at recession lows. Single-family permits have been falling for 4 months. We all see this. It's not like they don't see this. This is choice, right? They can change everything like this. They choose not to, right? They're waiting for that last push of data, and then things can change in that matter. But you could definitely get to kind of 6 to 5, low 6s, but it does need the labor market to keep on going lower.
I think it was last week or the week before, you were on a podcast that was mostly stock trader people or Wall Street people, and they were surprised to hear you say that housing was in a recession. And
yeah,
for people,
you always have to remember, if you're talking to stock traders, all they care about is price. If you go on Twitter, which is a pit of hell, that is price is all that matters, right? So the economics they don't care, right? So in their sense, housing's not in a recession because prices are at all-time highs. But the economic aspects of housing it's like what we did on CNBC 2 years ago around this time, where sales go down, wages go down, jobs go down, transfer of commission, incomes go down, right? Because the housing sector is a transfer of commissions, really, and moving trucks, right? So that's the existing home sales market. So jobs are down and incomes are down and transaction volumes are at record lows when you adjust it to the workforce, right? When I say all-time lows in sales, I'm counting 162 million people, both the non-farm payroll, self-employed. You put them all together where home sales are, they're really low. The construction side of housing is totally different, right? New home sales, housing starts, big ticket item purchases, what goes into a house, all those things. That's the residential construction workers. That hasn't fallen yet. That traditionally follows. Because it's funny, we do these data lines going back to 1942. It's actually really rare, again, to have nominal home prices fall since post-World War II. If you actually take 2008 out of the equation, in the 1990s, we had a flat year and down 1%. So it's not that we've had tons of housing recessions for all the decades, but stock traders look at price only. So the economic stuff is not kind of their wheel.
I just think it's like it is interesting. Just like we had different people in government, right, saying, I think it was the Fed was like surprised that, it seems like this is affecting housing badly. It's like, do you know anybody in housing? Do you know anybody?
Oh no, yeah, it's of course. Then there's Neil Kashkari. Then we go back to the president of the Minnesota Fed. Housing's resilient,
right?
Homie, it is the third calendar year of the lowest home sales ever. Now, when I say housing is resilient, I say it on the credit front, on the pricing front, on the lack of sellers, stress. It's resilient in that, because you have to remember, everyone has to realize this is my war cry for the last 10 years. The last 10 years, I was like, do not ease lending standards, keep lending standards as is. When that hits the fan, we will be ready for it. Right. So I have to defend all that entire decade of fighting people not to ease lending standards, because when we do see stress or recession, housing is going to have such a shield. Right. And it's going to be a beautiful thing to watch. And it is. Here we are. Guys, think about it. We've had the third calendar year of the lowest home sales ever. We have property taxes and insurance and all these things. And yet new listings data in 2024 is the second lowest ever. Why? Homeowners are in a good spot. That's the resilience that I see. But when people say, well, housing's holding up, what level of sales were you looking at to where, so partly Neil Kashkari is trolling, right? There's good cops, there's bad cops. He's not a voting member, so he could say some things that are off keel. But in this case, we all see the activity levels. To me, that's why the activity levels matter. I think it's just confusing for a lot of people to see home sales down this low and prices hit all-time highs. But again, I tell you this, everyone, I implore you, you do not listen to any single human being on America or on even planet Earth if they have never forecasted with their real name and face, at least for 5 years. They are trash. I'm using the word trash in the most polite way, but really deep down inside, imagine what I'm really thinking. You have to listen to people who forecast and have models, right? A human being can forecast, right? A functioning human beings. So anybody could say home prices are going to crash 20%, but they can't, mess up on their model, right? So you have to put them together. This is why I challenge people to live debates, because I know they're pretty much 99.99999% professional grifters, because even to this day, I have not yet got a forecast and a model, and I've asked all the men on Twitter and everyone else to give it to me. Let me see, zero. That's why they're grifters. So Neil Kashkari has a different take on it. Housing crash people have a different take on it. I focus on the economics. I know it's boring. Trust me, I get it. Economics done right is boring, but this is how it's been done since the Peloponnesian War, right? We are the nerdy mages all the way down in the dungeon with little candles, reading scrolls, and now we're here in this social media world where we have to dance on TikTok and do these crazy videos, but it all stays the same, right?
It does. Okay, so let's talk about if we have those lower rates, we've had inventory pickup. What do home sales look like at the end of 2024, given those two things?
So I've only seen housing have an authentic growth period when rates get down to 6%. And that's just a bounce. We're just talking about a bounce in sales. If you look at the economic cycles in the past 4 or 5 decades, housing has always needed a 2% plus lower mortgage rate move and staying there for a cycle. So if you want to say 7 to 8% is the high end kind of range, you need kind of like 4.5 to 5.75, or what I told CNBC this year. If you're talking about growing sales and keeping it there, 4.75 to 5.875. That, if it's there for like 2 years, all of a sudden everybody's like, oh, okay, this is where everything's at. What we've had in the last 2 years is rates fall down. We're at very, very low levels of sales. We get that one bounce, and that's it. Rates go right back up again. Sales fall down. So you need lower rates for longer for this to work, right? And that's what the data has shown us. Remember, in the early 1980s, affordability was slightly worse than what it is today. But as mortgage rates started to fall from very depressed home sales back then, it was like 2 million, like 1.89 or 1.98. That's a million. That's how it got. We got from 2 million to 4 million down to 2 million. All of a sudden, rates started to go lower and head lower with duration. And all of a sudden, sales started to pick up. And like people are going, it's the most unaffordable. It's like right now, people go, it's the most unaffordable time, but lower rates pick up. Why? Because people forget that wages grow every single year. And then you get more dual household income. So if rates go down, just like in the 80s, sales started to pick up. But you need that lower rates with duration for this to work, right? These moves that we have, 1% plus, they just give you bounces and then you can't hold them because rates go right back up. We need that entire market to change on the rate side to give people duration and time and choices. Because remember, it's not like you go, oh, the 10-year yield's at 3.99%. Logan is bringing out that photo that he says we all survived the 4% 10-year. I'm going to get up and buy a house right now. No, it's a process, right? It's all a process. So it takes time to get things going.
Okay, it seems very, very unrealistic to think we'll be 4.75 or whatever you just said. But what we've seen is that even when we get close to 6, we see a bounce. So if it got to 6 and stayed there, or in the low 6s and stayed there, you don't think that would have a lot of growth?
You can hold that first bounce. The question is, after that first bounce, how much lower do you need to go to take it to the next level, right? So a really good example, late 2022, early 23. Rates went from 7.37 to 5.99. We had 12 weeks of positive purchase up. It all filtered into 1 month, really. It's crazy. It all filtered at 500,000 home sales into 1 month. And then we talked about then is that looked like it peaked because rates went up higher. So if you stay there, you could hold those levels, right? It's still low historically, but you can't have rates go down and all of a sudden rates go up 1%, rates go up another 1% on top of that. That's not going to work with this marketplace.
Okay, last topic, inventory. Where are we? Where are we going?
Positive story for 2024. Still, inventory is growing. It should still be growing until the summer months, and then toward the end we get the seasonal decline. I think the one thing to look in the next, I would say 2 months, we're going to have the seasonal decline in new listings data. We still want that to show growth. I think the negative story we could have with inventory is if for some reason new listings data does its seasonal decline, but it's matching the low levels of last year. What we want is to still see that little gap between 2023 and 2024 data. More sellers that are buyers, that's good. Then if rates fall, then you get more net demand. But what we don't want to see is new listings data decline and kind of match 2023 levels. That's the thing for the next few months to look at our tracker data.
I was going to say, by the time this comes out, everyone can go look at the housing market tracker, which is weekly, and you've added so much to that. So there's almost 10 data points now on that thing.
Yeah, there's a lot of data points. Again, we track active inventory, new listings data, price cut percentages, pending sales, the 10-year yield, the spreads between the mortgage rates, mortgage purchase application data, and then we talk about what's happening next week. And then remember, we want to keep everybody in line with what's going on today. I'm going to get this report Friday. I'm going to be in a ranch and I'm going to get on a horse again. Remember that photo with me and the horse a few years ago? I had shorts on, shorts and sunglasses.
Listen, this is the most painful horse photo I've ever seen. Like, you do not wear shorts. And
I just want to add that I had not ridden a horse since I was 8 years old. And then while we were riding out, some cow came in and it made all the horses scared, and a bunch of people fell off their horse, but I held on to the horse with shorts on and sunglasses, no hat, no nothing, right? A bunch of people fell off, and I still hold on. So if I survive this weekend on the horse, the tracker data, again, is months ahead of everyone else, right? So the people that read it get to see what's going on live. And like we talked about last time, a lot of people were like, "Oh, inventory can't." No, inventory was already growing. It was much different than the 2023. See, what's happening this year in 2024, I wanted that to happen last year, and it just couldn't, right? Mortgage demand picked up early in the year to hold back inventory enough to where we had a late start. But when rates got toward 8%, you could see the inventory. So we're kind of just in that mode out there. But again, it's all there to keep people up to date with what's current, and then I put some historical perspective into it. And we always do we try to highlight the NAR data, the National Association of Realtors, 1.32 million active listings. Historically, it's between 2 to 2.5 million. Going back to the 1980s, it's 4 million in 2007, right? So historical context is good for perspective, but the weekly data is where all the action's at, right? Because that's fresh new data and it corresponds to the live. You don't want to wait 2 or 3 months to get an old stale report. You want to look at it now so you can look at it forward, and then we take it from there. And that's, I think, the edge about having weekly data that also looks out 30 to 90 days.
It's a huge edge. Okay. Logan, thank you so much for being on. Enjoy your horse riding. Buy some pants. Come on, man. And
I'm a SoCal guy. I'll be riding with shorts.
We'll talk to you soon. Thanks.